enough microbes for me. Who came for food and who came to listen? Who came for food? Yeah? You got some honest people. I see it all on Snapchat. I'm coming for food. It's a long drive, but I'm coming for food. Okay, and how many of you have heard about these two talking about farming without the bank? So there's a couple that have not. Alrighty. John, I don't know if you want to pass out books or not for them to look at, but if you guys can't see numbers, and you don't have to, John, but if they can't see numbers, it might be helpful. Alright, I grew up in Southwest North Dakota. My mom and dad were purebred breeders, Charlotte. Got a couple of those in the house. It's not very often I get to celebrate. They no longer have cattle, but they farm. My dad and brother farm together, and they farm about, between the two of them, 5,000 to 6,000 acres, something like that. I don't know where they're at nowadays, but anyway, so I do not farm myself or ranch myself. I'm not quite that risky. But I understand the numbers. So today I just want to go through some of the numbers, what farming without the bank is. I can talk super fast to make this go faster, because I know it's late, and apparently y'all want to. All right, we all know the problem, right? What's the problem? Banks rule your life. They determine how much money you get. They determine when you have to pay it back. Your livelihood is put up as collateral. We don't need to go necessarily over the problem because we already know the problem. But we need to have a solution. Because what we've done for 104 years is not working. The banks are shutting farmers down at every turn, or they're not giving you an opportunity. I was just reading an email from a banker, like 20 minutes ago. And he said he's been in the banking industry for 20 years, and small operations get loans differently than big operations. That's the first time I've ever heard that. So if you're a small operation and you're not surviving, is it because you're getting loans differently? Is it because they're not financing you differently? Are they taking more collateral? I don't care how many farmers and ranchers I talk to. It's seriously an epidemic in Nebraska. I don't know why Nebraska. But the feds are coming in and auditing the banks. So if you pay something off early, or you're paying something off and they're not releasing it from collateral, it's because the feds are auditing the banks and they've overlent. So if they've overlent to you, they need your collateral to make their books look good. It's not about you. It's all about them. And it's all about what they need to look like to the feds. Because the feds aren't going to lend the money to lend back out if their books don't look good. Okay? So the solution to the problem is you become the banker. It's that simple. But we have to change the way we think. We have to find a tool that's going to allow us to do that and do exactly what they do. So we're going to create a pool of money that we have access to without question. Nobody's going to question why you want it, when you want it, how you're going to pay it back. It is 100% your money. You are going to stop putting your livelihood up as collateral, and you're going to create a legacy for the next generation. That last bullet point is something that we do not think about because all we're trying to do is survive on a daily basis. Right? The next generation can fend for themselves because we had to do that. But can we do everything? Yes, we can. We need to do this in a tool that allows us uninterrupted compound interest. Okay? That's going to have tax-free growth, tax-free retirement, and it's an and asset, not an or asset. So everybody talks about compound interest. I'm talking about uninterrupted compound interest. Typical compound interest is interrupted. It's kind of like my diet. During the week I do pretty well. And you come here and she's got like a whole table of desserts, right? I just interrupted the loss, okay? It's very similar to that except the other direction. So uninterrupted compound interest is just going to keep growing no matter what because we never physically take it out. We never interrupt it. You put money in the stock market, it goes down. You interrupted the growth before it takes off again. You put money in savings, you take money out of savings, it goes down. You interrupt the growth. Okay? There's only one tool that allows us uninterrupted compound interest. There is only one tool that allows tax-free growth and tax-free retirement. There's only one tool that is an and asset, not an or asset. You can buy cows and your money grows. You can buy land and your money grows. Okay? You don't put it in savings or buy land. You don't put it in a stock market or buy land. You can do everything at once. What is that tool? Correctly structured dividend paying whole life. How many Dave Ramsey fans do we have in here? None? Are people just not great? No? Oh my God. Okay, dividend paying whole life. You get access. A lot of people are familiar with whole life and have been told probably not the best option, right? But if you correctly structure it, you get liquidity of your money for whatever you want, whenever you want, however you want. Nobody's asking you any questions about it. If it's structured correctly, you get access to 50 to 75% of your money in 7 to 10 days. You don't have to wait 15 to 20 years. And it is with a mutual company, so you're getting dividends. Okay? I am not talking about universal life, variable life, flexible premium universal life, flexible premium whole life. I am talking about straight up whole life dividend paying. If you see anything else, when you go home tonight, look at your policies. If you see anything on them except the words whole life, they are these other products which are crap. So go home and look. Who does not know what cash value is? I can skip these slides if everybody knows what cash value is. Okay, I see some heads shaking no, because they are not brave enough to raise their hand. All right, term insurance. You pay a premium, you get a death benefit, right? Simple. Whole life. You pay premium. It goes to purchase death benefit, but those premium dollars go into a cash value account. This cash value account is nothing more than an account that acts like a savings account. You get access to that money in 7 to 10 days. That's all it is. You pay premium, they give you a living benefit. Okay? So we want to create cash value in addition to having the death benefit. So if something happens, we have a legacy, but today we have that and asset. How does it work? Now, these are illustrations that are in the book. If you have Farming Without the Bank book, you can't see this. They're in the book, I don't know, I think it's page, depends on the version, 75, 78, something like that. If you put $100,000 of premium in, now don't be alarmed at the $100,000. I wrote this book when corn was $7 a bushel, okay? And cattle prices used to be good. So, cut it in half, take a zero off the end, it ultimately does not matter. If you put $100,000 in, here's your cash value account. You have access to $74,000. This column, how much does your cash value increase by? So if you put 100 in, 7 to 10 days later you have $74,000 you can borrow against. That's not so bad. We use 25% of that to buy death benefit. If you're going to take care of your family, you're going to have death benefit anyway. Year 2, We pay our premium of $100,000. Cash value increases by $77,000. Year 3, cash value increases by $99,000. Well, I'm from North Dakota, not South Dakota, but that's close enough to 100 for me. To say, geez, what I put in that year in premium, my cash value increased by, so I now have $250,000 of cash value. By year 8, I put in $800,000 and I have $818,000. Did I lose any money by year 8? Because every year after year 3, look at the cash value increase. I'm putting in 100, and this is just increasing every year well over 100. It's not magic. It's just dividends and interest. It's how whole life works when it is correctly structured for cash value growth. And if I die at age 58, my heirs get $5.4 million of death benefit. I've left a legacy. And I've had access to my money. So if we're going to implement this in a real life scenario, I'm just going to take a $500,000 operating, and I'm going to increase that operating by 2% every single year. So if I have $74,000 of cash value, and I have a $500,000 operating, I'm going to borrow $425 from the bank, and I'm going to borrow $74 from myself. Still borrowed a $500,000, right? I just took $74 from my policy, and I took the other $425 from the bank. So when I harvest or sell cows, what am I going to do? I'm going to pay the bank back $425, and then I'm going to put $74 back into my policy. I didn't create anything extra. I borrowed a $500,000 and I put a $500,000 back in. Year 2 comes along, and guess what? Now I can borrow $151 from my policy, so I only need $358 from the bank. I'm going to do the exact same thing. By year 6, I am completely out of the banking system, and I am using my policy for operating. I don't have to go to the bank for operating anymore. Is it going to work exactly like this? No. Because life happens. You're going to have an engine go out. You're going to have to buy a tractor. You're going to have a bad bull. And then you're going to have to go buy another bull. Right? Something is going to happen that it might not be exactly like this. And that's okay. It doesn't matter if you use this for operating or if you use it to buy a tractor and pay it back over 7 years. Or if you use it, I have a client right now that's got $90,000 of loans on his policy. He hasn't paid them back. I talked to him the other day. Those loans are not getting paid back for years. He is in an all-out war just trying to buy the ranch from his mom and dad. He is paying interest only on that $90,000 loan. But guess what that $90,000 is for? Bulls and cows. And guess what's not on his balance sheet? A $90,000 loan. The bank doesn't even know he has it, because he doesn't tell him he's got the policies. So he has the freedom to pay that back whenever he wants. That is going to give him freedom to buy out mom and dad so he can have his operation to himself. And everything can get transitioned over. So it doesn't have to just be for operating. And at the end of this, we still got the $5.4 million of death benefit. Questions? Anybody paying attention? This lovely lady in the red is. Okay. doing? Short-term notes versus long-term notes. It's crazy how many farmers and ranchers I see that are doing short-term 15-year notes. Why? So we can save interest? We have to be concerned about cash flow. If we're going to do a 15-year note and you want to pay extra on it, great. But when you go to the bank, why not do a 20 or a 30 and pay extra? Give yourself some room for cash flow. So if times are bad, we can still make that payment. When times are good, if you want to overpay, great. But what if we just took the difference between a 20-year or a 30-year and a 15-year and put the difference into a cash value account of a life insurance policy? What would we have then? The difference in payment, this is a 15-year note on this side, this is a 30 on the right. The 15-year payment is $192, the 30-year is $130. $62,000 a year difference in payment. If all we did was take the $62,000 a year, put it into cash value of whole life, by year 16, we owe 1.3 to the bank, and we have 1.3 in cash value. Could we borrow from the policy to pay off the bank if we wanted to? But what did we do for 15 years? We gave ourselves liquidity of all this money. We could buy land, we could buy cows, we could go on vacation, we could do whatever we wanted. But what we're doing instead is we're taking this liquidity and we're throwing it at the bank over 15 years. And then when we need something, we don't have it. When that land comes for sale next door, because somebody else didn't survive, we can't buy it because we don't have liquid money. Opportunity comes to those who have cash. And who's got cash? The banker? Because we've given him all of our cash. The only way we're going to be able to buy that land next door is to refi our land and put it up as collateral. Why? We need to have liquidity. If we want to pay it off, we can. Give ourselves some opportunity. We're not doing that because that's not what we've been taught. We've been taught to be debt-free. Guess what? The bum on the street's debt-free too.
Could be you.
Right? Yeah. Bet he wishes he had some liquidity. We need cash flow. Retirement. You guys don't ever think you can retire, but I'm here to tell you it's possible. You younger guys, you probably want to retire. That is, our younger generation does not want to work till they're 90. They just don't. They want to have an exit plan. And there's nothing wrong with that. If you guys can retire, this is the $100,000 scenario. We've got $2.1 million of cash value when this guy is 66, 65 years old. We're going to borrow $75,000 a year from this policy every year. We're going to borrow $75,000 and we are not going to pay it back and we are not going to pay interest. Guess what happens with the $75,000? Comes to him income tax free. Doesn't put you in a new tax bracket at retirement. Contrary to what people believe, there is not a special tax bracket for retired individuals. It's the same one. And who's paying the most taxes? Retired individuals. Because you don't have the write-offs. So if we can borrow $75,000 a year, why is that income tax free? Anybody?
It's a loan.
Because it's borrowed money. So when you borrow money from the good aunt, you were almost there. If you borrow money from the bank, that's not income tax to you. That's not income, right? Because it has to be paid back. Life insurance, cash value loans are treated the exact same way. It is borrowed money. It is not taxable. You can supplement your income and you can retire in a no-tax environment if you really wanted to. If you're going to rent out your land, rental income is passive, only subject to federal and state, not Social Security and Medicare. What kind of tax bracket could we be in if we're borrowing money from the policy and we have land rent coming in? Much lower tax bracket than most people. Okay? The reason we're paying high taxes is because we don't understand the tax code. Wealthy people understand the tax code. This is not a secret. So if we borrow $75,000 a year, guess what? At 85, he's not paid anything back or interest. He still left $3.4 million to his heirs. Well, that's not so bad. A lot easier to keep those off the farm kids happy, right? I'm going to pick up on a little bit tonight.
It's a couple bucks.
Okay. Oh my gosh. This is kind of a soapbox for me. Don't buy stuff to avoid taxes. That's craziness. That is absolutely craziness. If you have $150,000 of income and you buy a $50,000 piece of equipment, guess how much you saved? $11,000 in taxes. You spent $50,000 to save $11,000. If you didn't need it, did you save anything? You just decided who you liked more. You just hate the IRS so bad that you're going to spend $50,000? If that was cash, what could have you done with that cash? That would have created cash flow coming to you. But if you bought more cows, my God, at least they're going to throw some calves, and you got some income. What if you borrowed $50,000 to save $11,000? At 5% interest over 7 years, guess what you paid the banker? More than $11,000 in interest. So now, who do I hate? The banker or the IRS? That's all we're doing. If we need it, that's a different story. If we're doing it purely to avoid taxes, why? I talked to thousands of farmers. I've probably talked to 600 or 700 farmers and seen their numbers. I can tell you in about 5 minutes of a conversation looking at numbers who's buying stuff to avoid taxes and who's not. Because when we borrowed money at $7 corn or $6 corn, 7 years ago was last year. For the last 3 years, we've been struggling making those payments. If you can't pay for it with 3 1/4 corn, you shouldn't be buying it at 7. Because if commodities do this, right? And at what point in the cycle are we? We don't ever know. We have to think long term. The bank is not thinking 7 years out. He just is worried about you making your payment in the next 12 months. Your accountant is most likely not looking 5 to 7 years out. He's just trying to save you money in the next 3 months before March. You have to be smarter than both of them. As crazy as that sounds, you have to know your numbers. You have to think long term and see if you can make those payments. If you were driving down the road and John Deere had one of those, those big wavy signs, like they're on those sticks, and they're like 12% off. Who's going to pull in and buy something? Not one of you? I would be concerned about his cash flow. Okay, so if you're not going to pull in at 12% off, guess what? The IRS has a 12% off sale every year in March. Every year at the end of the year, you guys are buying stuff to save money on taxes. It's like a 12 to 24% off sale. It's actually harder on accountants than I am on bankers. And I told the accountant this, I'm like, am I saying that right? Like, I don't want to mislead anybody. He's like, I've never thought of that. Of course you haven't. Because all you're trying to do is save somebody from not paying taxes and telling them to go buy something. And that brings me to this. Who is running your operation? You? The accountant? Or the banker? The banker says, you can buy that. The accountant says, you should buy that to avoid taxes. And then you get mad because they told you that you should and you can buy it. Who wrote the check? You did. You have to know your numbers. I'm telling you, you guys, I get all my material from my family. When they call me complaining about the banker and the accountant, that's where I get all this stuff from. I'm like, quit complaining about Larry, because you wrote the check. All Larry's trying to do is avoid the IRS for you, because that's what he's made you believe. Okay, if you have a large sum of money and you have some sort of inheritance or you're selling out and the kids are taking over and there's an auction or somebody passes away and leaves death benefit, whatever, it doesn't matter. We can get money into the policy in a very quick manner. In this example, we inherited $500,000. By year 7, guess what? We have $500,000. If she dies at year 10, it's $1.1 million. We've doubled our money. I'm trying to go fast because everybody's sick of me. Okay, generational wealth. This is super, super, super important because we do not think this way. Can we leave the next generation better than how we were handed it? Every generation we buy the farm from the bank. Every generation. I get it. I buy it from the bank, I go to the bank, I borrow money so that I can buy Dad out, right? And because that's what Dad did to me, that's what I'm going to do to my kids. Every generation, the bank makes interest off of us. What if Dad is 60, what if he bought a $60,000 or $20,000 premium policy that had $671,000 of death benefit? He paid 60 cents for every dollar of death benefit. That death benefit grew, or the cash value in there grew income tax free. The death benefit got handed to me income tax free. Nobody paid tax, even while he used it. If this is my dad and he leaves me $671,000, what am I going to do with that money? Spend it in cash? Or go visit John and Steve and say, hey, I need a new life insurance policy on myself, and I'm going to take that $671 that Dad left me, I'm going to roll it into another policy. Over 8 years, we are going to put $671,000 in. What, year 1, $155,000, $80,000 every year after. By year 8, we put in $671, and my cash value is $720. Did I lose money? My death benefit, when I am 85, is $2.7 million. Dad's money grew income tax free. I used it income tax free. I passed $2.7 million onto my child income tax free, and I've paid 16 cents for every dollar of death benefit. What is she going to do? Well, because I'm going to be dead. When alive, I'm going to be John. She's going to go see John, right? And she's going to roll my $2.7 million into more life insurance on herself. It's all going to grow income tax free. She is going to have a premium of $85,000 at year 8. If I just left my kid $2.7 million and she can't pay an $85,000 premium, we have bigger issues. Right? I didn't do my job teaching her how to handle money. So she pays her premium of $85,000 on 11.6 million to my grandchildren. Income tax free. We have paid 16 cents for every dollar of death benefit. Where else can you buy a dollar for 16 cents? Income tax free, guaranteed. No place. Between all of us, between all three generations, we've paid 18 cents on the dollar. This is generational wealth. This is leaving the next generation with an opportunity to expand. You work really, really hard every single day to build your operation, but we don't work to protect it and to make sure that it outlives us. We say what was done to me should be done to you. We don't need to do it that way. We can leave it better without leaving them spoiled. Because this isn't about leaving spoiled brats. If they're out there doing the work beside you for 20, 30 years, are they really spoiled? Or have they shown you that they can do it? Plus, you raised them. I told my husband that yesterday. I told him that my stepdaughter was what did I call her? Pansy. Yeah. She cries about everything.
Not what I was thinking.
I have no feelers. And I'm like, oh my God, she's a pansy. She was not raised like me. You want to cry, I'll give you something to cry about. Okay. So this is not just for operating. We can use it for retirement. We can use it to buy land. We can use it to send the kids to college. We can use it for vacation. We can lend money to other people. I have a lot of clients with money sitting in cash value. And some of them are doing personal lending. So somebody might need a car, somebody might need land, somebody might need business startup money. You can do whatever you want with that money because it's yours. 100%, nobody asks you any questions. If you are the kid taking over the operation, you should have a policy on mom and dad so that you can buy out the siblings if you need to. Or mom and dad, you should have a policy on yourself to give to the off-the-farm kids, and then the kid on the farm gets the farm. However you want to do it, there's a million ways to do it for estate planning. But whole life needs to be a part of your estate plan. Not universal, not variable, not indexed. Those policies will collapse on you because they're based on the market. Don't be buying crap life insurance and then hoping that it's part of your estate plan. And don't go to your attorney to buy life insurance. Don't go to your accountant to buy life insurance or your banker. You talk to Steve and John because they understand life insurance. I cannot tell you how many people I see with horrible policies and that they collapse on it. Okay, we can insure parents, kids, grandkids, employees, business partners, and landowners. If you are renting land from somebody and you know you're going to have first right of refusal on that land and they are insurable, it might be an option for you to be buying life insurance on them so when they pass, you can buy those kids out. And you don't have to go to the bank or you don't have to lose the land you've been farming for 15 years. Now you've got the ground where you need it, and all of a sudden you lose it to somebody else. Especially in today's day and age where we're doing regenerative ag, we have stuck a lot of time and energy into that ground. And then somebody else comes in and is putting chemicals on it that you were trying to avoid. That's a big thing. Owner finance the land. This is huge. A lot of parents say, you just buy me, you just go to the bank and buy me out. I'm going to sell you this land for $2 million, you just go to the bank. Or the neighbor guy wants to sell, and he says, just go to the bank. Ask them if they'll owner finance you. I have a client that did this exact scenario. The The guy was selling for $2 million. And he was going to do a 20-year note. And I said, well, we ran the numbers. And if he did a 20-year note, he was going to make $1.2 million of interest at 5%. If he did a 30-year note, he makes $1.9 million of interest. Interest income is passive, subject to federal and state only. He could sell his land for $2 million and make another 1.9. I just doubled my money. Owner financing somebody. And I have a payment of $130,000 a year. It's a pretty nice retirement, supplement to retirement. Why go to the bank? If he'd have went to the bank and got the $2 million check, guess what? He'd have had to pay capital gains on that, and he'd walked away with less than $2 million. Some people say to me, well, Mary Jo, what if they don't pay? Great, you got the land back to sell. Right? It's not a loss. It's your land if they don't pay up. I'm okay making $1.9 million if I just have to go to the attorney and have a contract for deed drawn up for a few $1,000s. When you show a farmer this, they're more apt to owner finance you. And if I'm 60 or 70 years old and they can't afford anything less than a 30-year payment, well, if I'm okay with $130,000, can they continue to pay my estate upon my death? I can put that in the contract for deed, right? Or I can make a 20-year balloon payment or something. More ways to do things. But don't be giving up the interest when you can owner finance somebody. All right, frequently asked questions. What if I'm uninsurable? Oh, then we go to a spouse, or a grandkid, or a kid, or business partner, whatever. There's usually a life there to insure. We can own policies on other people's lives. This client that I was telling you about, that everything went south. I've got quite a few of those, but everything went south with mom and dad. He has a policy on mom's life. So he's type 1 diabetic, uninsurable. So we bought 2 policies on mom. He has a $90,000 loan on that policy. When mom dies, that loan's paid for. But mom said to him the other day, I want my name taken off those policies because I don't want you to have any money when I'm gone. So he called and said, can you take her name off? No, she's the insured. Once you own a policy on somebody, you own the policy. The only way for that policy to be canceled is if it is court ordered, and he would have to cancel it. There's no taking her off. If you have a business partner and that partnership breaks up, you continue to own that policy until the day that guy dies, or that girl dies. Where do I find the money to start the policy? Well, apparently you can buy cheaper crop insurance, so there's probably some savings there. So I just found you some money. Most of you are using cash to buy things, and we're just pre-buying. Can we put some of that money in? Are you overpaying to get debt down further? Do you have short-term loans? I don't really know what you're doing. If we sit down and do a one-on-one meeting, I'll find money. Because we're not thinking of how we're using it correctly. Okay? And how much do you start with premium? I don't know. I got a 20-year-old the other day that started with, I think we put in $2,000 a year. And I got people that are doing $500,000 a year. Depends where we're at financially. Depends who you are, depends what you're doing, depends how you're handling money. I can tell you, you guys can be farming and ranching right beside each other. Everything could be identical and one will have money and one will not. It's just how you're handling and utilizing your money. Every single person's operation is different. Can I use operating money to start a policy? No, no, and no. Never, ever are you going to rob Peter to pay Paul. Not happening on my watch. Can I put a lump sum into a policy? No. Because it's going to cross the taxation line and we want it all to grow tax-free. So there's a specific way that we have to structure the policy. How much insurance can I get? Depends on what your gross income is. Anywhere between 40 to 15 times your gross income. The older you get, the less. But you can have up to that much. Why haven't I heard about it? That is a good question. Oh, there's your gross income. So pick your age times whatever. So if you're 50, it's 15 times your gross income. If you're under 40, it's 30 times your gross income. And I mean gross. Because if I had to use net, I wouldn't get any of you ever insured. So gross income, okay? Wells Fargo, JP Morgan, Citibank, Bank of America, US Bank, and PNC have $72 billion of cash value, life insurance. This is their tier 1 capital. It is what they have to have in order for the feds to lend them money. Since the 2009 crisis, they have increased the amount of cash value life insurance that they have. If the banks are using it, why aren't we? They have to have liquid money. This is where they're using. This does not include their death benefit. This is just cash value. The death benefit is in the trillions. Also, when we bailed them out, they had this money. Isn't that nice? Okay. That's it. Any questions? I usually give prizes for questions.
How much interest do you gain? Like how much percent?
You are going to gain 4% guaranteed by contract. Let me. Oh, I don't have my thingy. One second.
Great job. 4%. That's your point. Plus your dividend.
Tomorrow.
I'll need it back by Friday.
He's got it in his pickup probably.
Yeah. Probably Ethan's pickup might not be in there though.
You can probably stop it.
What if they want to hear the frequently asked questions?
I don't know what she's going to get.
Dear John, man.
Okay.
Sorry.
If you have cash value, let's say that you've got cash value of $50,000. It doesn't matter what it is. But that is going to earn you 4% guaranteed by contract plus the dividend. Dividend right now is about 1%. That is a 4% gross from now until age 129. Okay? When you borrow against that money, whoops. Life. What the heck? I don't know what I did. Okay, whatever. Life insurance company borrows you their money. So your money is over here earning 4%. They lend you their money, and they use your money as collateral. They're going to lend you their money at 4.76. Well, yours stays in there uninterrupted, earning 4 plus the dividend. Okay? The death benefit is collateral to the loan that they lent you. So if you have a loan on the policy and you die, your loan gets paid off through the death benefit and your heirs will get the difference. So we're putting our death benefit up as collateral, but our money never ever leaves the account, continues to earn interest. We get to pay it back whenever we want, however we want. Doesn't matter. Because we're all going to die.
So then when you take money out, so say you take $100,000 out, how much interest do you have to pay back? Because I understand that you don't have to pay it back, but you should pay the interest.
So you
Correct.
never take the money out, you borrow against it. But however many days you borrowed money for, they charge you interest per day.
Okay.
It's like prorated.
So what's that interest right now?
4.76. And they haven't changed it in my policy's 10 years, 11 years old, they haven't changed it in 9. They went from 4.25 they went from 4.5 to 4.76.
So your money is getting 4 point, what do you say the money is?
Your money's earning 4 plus a dividend. So about 5. And you're paying.
How's that dividend paid?
Based on how much death benefit you have, how much your premium is, your health, your age, how old your policy is, some big one formula.
Can you elect to leave the dividend in the policy?
The dividend automatically goes back into the policy to buy more paid up insurance and goes right back into cash value. The dividend never comes out to you unless you ask for it to. And if you do, it is an income tax-free dividend. Unlike a co-op or something like that where the dividend is income. Because in life insurance, the tax code, it is a return of premium. So it is not, there's no taxable event there.
So all the money that goes in, has to just, you pay taxes on that money already, right?
Yep. You're either gonna pay tax today or pay tax tomorrow. The gentleman, Steve and John have books back there. They are being super nice. I would not be this nice, so take note. They are being super nice and they are going to give you a book if you read it. If you're going to use it as a paperweight, please do not take it. It is meant to be read. The gentleman that developed this concept is R. Nelson Nash. He wrote Becoming Your Own Banker. This is my financial Bible. This is what I've learned everything from. Nelson died in April of last year. He was 88 years old. He had 49 life insurance policies. When one got full, he just started another one. Okay? John and Steve were in Birmingham with me a couple weeks ago, and we saw what he left his children and how they're using the policies and how he's created the legacy. When I talked to him in February of 2019, he had just bought a life insurance policy on his great-grandchild. Every single person born into his family had a life insurance policy. And before he died, he left that policy to them. They inherited cash value, income tax free, and he got to see that legacy before he was gone. Okay, we don't have to wait until we're dead to leave something to our heirs. If we want to do that while we're alive, we can. And we can make them the owner of the policy we own on them whenever we want. Every child matures at a different level. Right? Jack is going to buy stuff at 12% off. I wouldn't give Jack his follow-through. He's going to go see Kirby and be buying four-wheelers.
Kirby don't mind.
So there is the Becoming Your Own Banker book back there. If you've got the Farming Without the Bank book already, I would grab this one because you're going to understand the concept even better. Farming Without the Bank was written as an intro to this one. Wealth Without the Bank or Wall Street was written as an intro to this one. If you don't understand life insurance, this is a hard book to understand. Nelson talks in parables and riddles, and I didn't understand this. Why do I care about an airplane? Like, he's got airplane analogies in here? I don't care. I want to know about finance. There's a reason for it, but you have to have the thought process behind it. Ideally, Farming Without Wealth Without the Banker Wall Street was written more for non-farmers. So if you want that one, take whatever you want. And then Warehouse of Wealth is also back there. That is Nelson's second book. There is no numbers in that book, but it is a great book to help you understand, again, why we need to create this Warehouse of Wealth. Okay. So over there's books. You must read them. Any other questions?
Yeah, at the very beginning, you started out, bank uses our collateral as what?
So the bank, this is gonna send me down a rabbit hole. The bank is fractional reserve banking, right? That's what's going on in our system. So the feds lend the money to the banks. So the bank needs your collateral so that the feds will lend them money. So not only do they have the life insurance, a lot of little banks don't have life insurance because they're not that smart. But they will use, so on the books, they have to have enough collateral to the loans that they have. Well, they don't just come in and look at your collateral to loan ratio. Like they're looking at the whole book. And so if you just paid off some land, they might not release it from collateral because Kirby, they overlent to him, and so now they need to use your paid off land as collateral to overlending to him. Does that make sense?
What percentage of the purse pocket, whatever you want to call it, the amount of value the bank has to have based on what the feds will borrow them? So let's say for every dollar, what will the feds borrow them?
10.
Okay.
Thank you for coming and listening to me. They have, for every dollar you put in the bank will go to the feds and get $10. They have to hold the dollar and they can lend $9.
Okay.
That $9 is nothing but a number in thin air. It's called fiat money.
Okay.
That's what's causing inflation.
Yeah. Got it.
So our Oreos, our package of Oreos is not getting smaller, and Walmart is not charging too much for those Oreos. It's just the fact that the devaluation of our dollar, it takes more dollars to buy that package of Oreos.
Yep.
It takes more dollars to buy that tractor.
That guy that you were saying that borrowed the $90,000, I understand, he's still got to pay in his.
He still pays his premium, yes.
Okay.
You need to pay your premium and your interest every year.
So then things really go south and he can't pay it. What happens?
We set the policy up so that in worst case scenario, you can pay that premium. Because there's no point, I don't know. The policy is, the premium is flexible. So of this $100,000 that's of premium, only $25,000 has to be paid every year. So only like 25% of your premium is gonna have to be paid.
Okay.
So worst case scenario, you can pay the 25%. Best case, we're putting in 100.
Okay.
And in a traditional whole life policy, there's no flexibility. Anything else? Okay. Universal whole life is basically a renewable term with lots of expenses tied to the stock market, and it will most likely collapse by the time you're 75. So if that's what you have, you want to go home and you want to call your agent, get an enforced illustration, and it'll show you what's projected to happen. There's ways to save it, and there's ways to get the cash value out without paying taxes. Talk to Steve and John. And they can send it to me, and I'll take a look at it. If it's a great policy, I'll tell you to keep it. I've never seen one in 11 years, but there's always that one day. Sorry. Hey, it's better to find it. It's better to find it now. Like I found them when women were uninsurable with no money. I had to tell a guy one time, like, your only option is to die within the next 12 months, or there's no policy, and he was uninsurable, and they were filing bankruptcy. That was a shitty conversation to have. Because somebody sold him a bad policy. Nelson was selling life insurance the majority of his whole life, and he never sold a universal life because the numbers never worked. Companies are being sued for overestimating what interest rates are going to be. Go home, enforce illustration. Might want to write that down. All right, anything else? I know everybody's itchy to leave. I'm gonna